Hey guys, this is Lane with the Simple Passive Casual podcast. Today we're doing a webinar on the life insurance. A lot of you guys had a question on this. We did a podcast a long time ago with Chris, and we kind of touched upon the idea of the infinite banking concept using life insurance. And the inspiration for this webinar was I recently had a friend who got sold this life insurance, and as we all know, the life insurance, if you don't need it, it's a very expensive thing. And there's very heavy fees for this. When you go about doing it, it's a tool, and like anything, it's right for the right circumstance. Today we're going to talk about what a lot of the wealthy do and what I have done in my portfolio. You can call it infinite banking, you can call it a lot of different things, but essentially what you're doing is you're creating a liquidity account that you can go in and take a loan from yourself, and offers asset protection. But I guess wanted to introduce Chris Miles, who does a podcast at moneyripples.com. You guys can check it out. But why don't we start at the top, Chris, and you can take us through this.
Sounds great. Hey, welcome everybody. Hey, you know what? I'm so glad you're on tonight, because tonight we're going to absolutely crush it. Here's how. Like, I want to talk to you about something that so few investors know, and usually they're just the wealthiest of the wealthy that actually use this. Banks included, corporations, people like that, and definitely wealthy individuals too. But this is something that we want to really bring to a normal person level, right? Like something that can actually be available to you as well. You don't have to be super sick rich or anything like that. You can actually be really well. You can actually become wealthy doing this very method. So just a check here. I want to get everybody here. Just go ahead and use the chat feature. If you see the little chat you can do on this, go ahead. I just want to see if you guys are on, if you guys can hear everything okay. So like Jackson, Mark, Lisa, and anybody else that's on. Let's see what you got here. Well, those came in fast. All right, good. Well, awesome. So how many of you, while you guys are using chat, how many of you guys have actually heard of this before? How many of you guys have actually heard of this kind of thing before? Or is this first time?
And I think a lot of people have heard this, but it starts off really simple, then it kind of quickly speeds off, right?
Yep, exactly. Okay, so Mark, you read in the book by Nelson Nash. Great. That actually opened up my mind about 11 years ago when I first read that too, and blew my mind, because I was like anti everything about this. So I just didn't know we're going to teach you how to do it better than what Nelson was doing, because Nelson was doing it the slow way. So for most of you, it's been about first time, right? Or you just heard about it. So give you a kind of background on me. For me personally, like I actually started out being the traditional financial advisor, right? Like my whole goal was to go into business because I wanted to control my own destiny. I wanted to make as much money as I wanted. I wanted to do everything that gave me control and freedom, right? Same reason why I do investing, is I want control and freedom. And what ended up happening is my first business ended up becoming a financial advisor. Now, I wasn't a genius, but I quickly learned to trade. And it was a matter of about 3 or 4 years, I started to realize that all that financial advice, that crap doesn't work. I'll tell you, like, it doesn't matter how much you pack away into mutual funds, unless you lie about rates of return and about all the things that happen in your life, you will never be able to retire in a decent way using the typical 401ks, IRAs, and all that stuff. And I'll be flat out honest, even when we're talking about life insurance here, you won't be able to retire off this either. I mean, you've got to do things that are outside the box. This is why you need investments. Thing is, I'm going to teach you how to get the same money working twice for you instead of just once. And so I started out as that financial advisor, started to question everything, and especially when I met millionaires, they totally think differently. They would say, hey, Chris, like that whole save for the long haul, that's dumb. What about cash flow now? And you know what? And I could go try to get 10%, but I can make way more in my business or in my investments. So why would I ever invest with you? And you know what? And that was great. I'm glad they said it, because in March of 2006, I quit. I vowed never, ever to go back to financial advising again. And now, lo and behold, what ended up happening is by applying some of these things, not just this, but everything, investing and creating residual and passive income streams, I was actually able to retire in July of 2006. So I was 28 years old and able to retire out of the rat race, and then had no clue what to do with my life. And it was at that point, that's when people started to say like, hey, Chris, like, how did you do it? And that kind of stuff. And it kind of got me back out. And honestly, I was like, wow, it happened so fast. Can I even teach this? But over the years, over the last decade or so, I've been teaching this. And I'll tell you, I've been through the Great Recession. I've been through thick and thin, the good, the bad, and the ugly. And I'll tell you that the one thing I've learned that's key is that it's truly about cash flow, is that cash flow is what creates freedom, right? And I know I'm preaching to the choir to you guys because that's nothing new, but it doesn't matter how much money you have saved in a bank. It doesn't matter how much of equity you have in properties. If you don't have cash flow, you're just asset rich and cash poor, and you're still in the rat race. You're still stuck. And so this is key. And so we want to make sure that this ties all together, right? So to do this, there's really 5 basic rules you should know. I call them the 5 rules of the bank. Because think about it, who's got more money? You or the bank, right? I mean, obviously the bank has a bigger house. Go to any city, you know the biggest buildings are going to be banks, right? So why not do what banks do? And as an investor, you're already trying to do this. And I already guarantee you're trying to apply some of these rules. But I think it's important to remember because you got to apply these rules everywhere, right? That was almost like a little Jedi thing that I just did there, everywhere. These are not the banks you're looking for. Okay. So seriously, so 5 rules of the bank, pretty simple. Obviously they want your money. So rule number 1, how often do they want your money? As often as possible. Rule number 2, how much of your money do they want? Obviously as much of it as possible, right? Number 3, how long do they want your money for? Now we all know this. If you've ever had retirement planners talk to you, it's forever. Let it stay in there forever. Let it compound interest because that's the 8th wonder of the world, right? All that crap. And then 4, then the 4th one is how much do you take out? As little as possible. You ever heard people say live off the interest? Or now people are saying live off less than the interest. Most financial planners will say today that whatever money you've accumulated, you should only live on 2 or 3%. So that means if you happen to save up $1 million in your retirement plan, they're saying don't live off more than 20 or 30,000 a year. Congratulations, you're a millionaire that just pretty much went into poverty. Congratulations, right? That's awesome. And then the 5th one is how much risk do the banks want to take? As little as possible. And therefore they want you to take all the risk as possible. You ever heard high risk create high returns? Yeah, that's the banks telling you to take all the risks so they don't have to. It's bull crap. And
I mean, that's what like really pissed me off, Chris, is like I actually sat in on this call and helped somebody go about do this, and then that was the line that was used, like, hey, we want to do something conservative here. And then it's like, that's like ridiculous, right? Like, and then like, so then I'm telling about some things I do, and he's like, oh, that's really risky, like 20%, 30% plus a year, that's pretty risky, right? But that's just like, they lead into this, the fear tactic, right?
They sure do. Yeah. It's crazy. I mean, if you look at banks don't do any risk. I mean, they do as little risk as possible, other than the ones, of course, from the Great Recession that decided to over leverage themselves, right? And then we had to bail them out. But for the most part, they don't want to take any risk. They get the guaranteed fees out of your accounts. If you put money in your 401k, you're paying usually at least 1% administration fee every year to that 401k. They get that guaranteed cash flow. You don't, right? You're just riding the waves. You're gambling it, hoping you get something great. And in truth, you get mediocre at best returns. It's crappy. And so if you think about the 5 rules, they want you to put in money as often as possible, as much as possible, for as long as possible, take out as little as possible, and take as much risk as possible. Or in the bank's case, they want to take as little risk as possible. Those are the rules that we want to apply here too. And so when you look at a bank, it's all about acceleration, not accumulation. They're not trying to accumulate money. They're trying to accelerate it. They're trying to put it in motion to create velocity, right? So how do we make money twice? This is it. You got 2 options. You can either use cash or you borrow money. I mean, pretty simple, right? Any investor knows this. You do a property, you probably do both. You probably use cash for a down payment, and then you probably borrow for the 80 or 75 to 80% of the mortgage. And in some cases, yeah, maybe you get a home equity line of credit to then cover your down payment too, and that's great. Then you're borrowing twice. But it's pretty much, that's it. Either you liquidate savings or you borrow money from somebody else. You're always using somebody's money, whether it be your own or someone else's. And what's important to know is that you're always paying interest. Always. Now, this is hard for some people because if you're taught the traditional way, you're taught that borrowing money is evil, right? And obviously, if you guys know Lane, if you listen to him at all, you know that borrowing is actually not a bad thing, especially if you do it wisely. If you're a wise steward of it, borrowing can be one of the coolest things and probably the only way that you can do it legitimately and still have financial freedom, because most people can never save their way to wealth. I've met with those people over decades. This is why I left being a financial planner. People get 20, 30 years of advice and they still didn't have enough. It didn't work. The whole, hey, if you just save $100 a month for the next 40 years, you'll be a millionaire. It's crap. It's not true. And so you're always paying interest. Either one, you're paying interest to a loan, to a bank or some other institution, or two, you're foregoing the right to earn interest. You have a lost opportunity cost, because if you take out money out of your bank account, you pay that money into savings, even though you might make money, let's say on an investment property or something, or a coffee farm or whatever it might be, even though you put that money into it, still you're paying interest because you've lost the ability to earn any interest on that money. Now you just have the investment to pay you interest. So the question is, how can we do both? And which one's going to make more sense? Now, if you have guys like Dave Ramsey or Susie Orman, they don't get it. I mean, Dave Ramsey, he still teach people that you can save $1,000 and then you should just go and pay off all your debt. Like somehow $1,000 is enough for people to live on in case of emergencies, right? Like that stuff doesn't work. Now, the tool we talk about using is whole life insurance. Now, there are different types of life insurance out there, and I won't go into a lot of depth, but obviously, term insurance. Term insurance is you pay it in, and then the only way you ever get any money out of it is that you die, which means you don't get any money, right? Somebody else gets it. So it's basically a pure expense. And there's other types of insurances, but this is the only one that does what I'm talking about here, especially when there's the magic of how you are able to leverage interest in your favor. There's only one that allows you to do it, and that's whole life. And I'll tell you, you talk to Susie Orman or Dave Ramsey and those guys, they will tell you that whole life sucks. They will tell you that it's horrible, that you get no return, and that essentially it's just expensive term insurance and you shouldn't even have it. You just buy a cheap term. And you know what? Based on how almost every single insurance agent sells whole life, I would agree with them. And now there's some things they still have wrong, but for the most part, if you do it the traditional way of whole life, I mean, think about it. Whole life, you put in, say you put in like $25,000 a year. In traditional whole life, the first 2 years you have zero cash or very, very little cash in there. So you put in 50 grand to have almost nothing to show for it. That's pretty dang expensive insurance. Would you guys agree? That's what typically happens. Why? Because that's what the insurance company tells them to do. Also, that's also what agents want to do because that's where they earn the highest commission. The reason you have no cash value in the first year and sometimes even the second year is because they're earning commissions on that money. Now, in 2006, remember, I was a financial advisor from 2002 to about 2006. I quit. I started getting trained by guys that were millionaires. And I remember the guy I was meeting with that did sell me whole life. And this guy said, hey, this is awesome. It's cool. It's a permission slip to spend money. Great ways to leverage it. He taught me about Nelson Nash's book, Be Your Own Banker, which I was like, oh, cool. Like, I didn't know you could even do this stuff. Hey, you basically essentially become the bank yourself instead of borrowing money. Now, I've known life insurance well enough that I asked him point blank, I said, hey, is there a way I can get cash in the first year? Can I put more in than what's required? And you know what he told me? He said, no. Now, a couple years went by, Great Recession hit. My real estate was sucking as well as my business at that time. And so I was in a place where I was in the hole $16,000 a month. I went from millionaire to like upside down millionaire in a matter of a couple years. And cool thing is I was able to pay off all that within a matter of like 3 or 4 years. But the thing is, it absolutely sucked. I was cash tight and I couldn't keep paying. I was paying over 10 grand a year. Actually, it was probably close to about 12 to 15 grand a year into my whole life policy at that time. Now, I wouldn't have any cash in that thing till the third year. I was barely in my third year when all of a sudden the cash crunch hit. I couldn't keep making those payments and I lost my policy. I put in well over 25 grand only to lose it. I would have been way better off just having cheap term. What I found out later is that I could actually put in more, and if I had done that, I would have been able to keep the insurance. I could have stopped paying for a couple of years, and it would still have been going just fine. When I confronted that guy about that life insurance agent, I actually pulled out the numbers. I said, hey, if I do it this way, I'll have just as much, if not more cash than what you're showing, and even just as much death benefit. So I did that. And you know what happened? He, after a 2-hour screaming match, it finally came down to, he said, well, I just don't want to, I can't afford to cut my commissions that much. That was his freaking answer. And so
Hey,
like,
Chris, so like, so the whole life is obviously the thing that these life insurance guys like to sell, because it's cha-ching for them. What is it that's like what we're doing here? What's the difference? Like, I know the death penalty, the slider, it goes a little down, but how does that affect things? Like, what is, when you go in there and you change it, what are you changing to make it work for this strategy?
yeah, pretty easy. I cut back the costs, you know, as much as I legally can, and keeping it still tax-free. That's the key. And so, for example, in most people's cases, I can usually cut it back to the point, you know, to where you have about that first year, say you put in that 25,000 that first year, most people would have zero. I can do it to the point where it can usually have at least roughly, again, in the ballpark of about, trying to do the math, about 75% of 25,000. So that'd be, what is that, 18,500? I'm just doing that off the top of my head. That sounds about right. Pretty close. Or 18, it's about 18,000 bucks, right? I can usually guarantee there's at least 18,000 bucks in that first year. Why? Because I cut back the commission charges and all the other company fees by 18,000 bucks. So I could save people a pretty significant amount of money just by doing that. And then even the second year too. And again, most people have almost no money in the second year. Same thing, but now you have about at least 20 grand going in of that 25,000. So if you put in 50,000, you would probably end up seeing having roughly in there about 43,000 or so.
So what is the guy getting the commissions on that you're scaling back? Like, and there must be some metric that what the commission structure is based on, right?
Yeah, it's just based on, I mean, the company figures it out for them, but it's really based on the first year's premium. You know, whatever you put in that first year, they get paid a percentage of that. So if you put in 25,000, the reason you have zero is because they got paid a percentage, you know, maybe most of that 25,000 was what they got paid in commissions. And in fact, I've had guys have been in insurance forever, and I've told them to switch their method, even when I've tried to refer them business. And the thing is, they don't want to do it. And they don't want to do it because they again, think in scarcity, thinking, oh, well, if I do that, I'll get paid almost, you know, I'll get paid like 75% less. I can't afford to do that. But here's what they don't understand. They don't understand when you do it right, especially when someone has an investor mentality, they're thinking, wait, and we haven't gotten into why we do this. We'll talk about that in a second. But the investor mentality is, wait, I want as much of my cash, you know, not going to expenses and fees. I want as much of my cash going to that savings component where it's tax-free and it's free from creditors and lawsuits. If you realize you don't have a public record, you could be a millionaire in life insurance in the cash value, and people cannot sue you, or creditors cannot make a claim on your life insurance at all. It is totally free from creditors and lawsuits. And it's free from any sort of taxes too. It's taxed just like a Roth IRA, but the difference is you can put in way more money than a Roth IRA, and you don't have to wait until you're 59 and a half. You can pull it out this month. You put it in this month, you can pull it right back out if you do it the way that I teach. You do it the other way, it'll be more like Nelson Nash's method, which you have to wait 5 or 10 years before you have any money in there to do that. So that's the key, is that everything, the reason why you don't have any cash in there is because it's going to commissions and fees for the company. I wish it could try to get rid of all the fees, but you just can't do that legally. So I try to get right to the point where it still stays tax-free. If you go too far, if you put in too much for the insurance, it becomes like an IRA. So there's a limit. But that's why I said, like, if you even put in 25,000 a year, you'll probably have about 18,000 in cash value in just that first year alone that can then be used immediately to go and invest with. And then pretty soon by your third year that you're doing it, every dollar plus dividends, tax-free dividends, are being paid into it, that you now have this supercharged savings account. So does that answer your question, Lane? Is that what you wanted?
Yeah, I'm sure we'll get to more.
Oh, we're getting to more. Yep. So let's talk about why it works, or why we use this instead of just a savings account. Because really, you got two choices when you're going to invest with money, especially if you're putting down payments on properties or whatnot, or any investment. It's either one, you come out of your savings account, or two, you borrow it, like I said, right? Well, the one thing you have to understand of why this works, you got to understand that there's two types of interest: compound and simple, and they're not the same. So to give you an example, if you have a $200,000 mortgage, in 30 years, if you pay 4.5% on that mortgage, which I know is still pretty high right now, but say you pay 4.5% on that, over 30 years, if you make the minimum payments, you'll pay $164,000 in interest on top of the $200,000 in principal, right? So that's your cost. Remember, I said you're always paying interest, whether you borrow it or whether you pay the money out of pocket. Your best case scenario with a mortgage is if you can't leverage it, the best thing to do is just pay it off from day one. If you paid off from day one, you'll save yourself $164,000 over 30 years, won't you? The problem is that if you pay that $200,000 out, say you took the $200,000, just paid off your mortgage, maybe you liquidated everything you had asset-wise to do that. Well, yeah, you don't have a mortgage, and you did save $164,000, but now that $200,000 is gone, you can't be making any money with it. You can't go and invest with it. So the question is what if we can invest with the $200,000 and not pay off the mortgage? We know it's going to cost us $164,000 at 4.5%, right? So the question is what would it take to beat it? Now I'm going to be a total devil's advocate here. I'm going to say that you basically find a savings plan that only pays you 3.5%. So I want you to kind of think in fact, go ahead and put it in your chat right here for those of you on here. If it's 3.5% that you're earning on 200,000, and you already know that 164,000 is what you pay for 4.5%, what do you think 3.5% would be? So if 164,000 is from 4.5% on the loan, what do you think 3.5% would be for the savings? If you were to try to save at 3.5% over 30 years, what do you think it would be? Just throw out a number. Curious to see what you guys come up with. This is like The Price is Right. Somebody might even bet $1. Earning 3.5%. Lane, $163,999. He's like $1 less. Awesome. All right, who else? 111,000. Matt, good, Matt. So I'm guessing you're probably just taking the proportion, right? Perfect. Probably a common answer. I wonder if other people came up right around that same number. All right, anybody else want to take a stab at it? All right, for each of you, it seems like it's less than 164,000, right? You want to know what it is? Bam. 3.5% on 200,000 over 30 years, you earn, in just interest alone, not principal, interest, $361,000. Now remember, if we go back here, it cost you $164,000, right? But wait, you just made $361,000 while earning less? How is that possible? How can that even happen? This is where the two different interests come into play. 3.5%, what's happening is compounding. See, when you pay down a loan, just like a car loan, you ever notice that as you pay the payments, more and more goes to principal and less to interest? Your interest declines, right? Even when you pay down a mortgage, the amount of interest you're paying declines. It's not accumulating, it's not growing and compounding. Your interest is declining with every payment you make that you're paying down principal. And so that's simple interest. But with savings, you got 200,000 in there. If it's making 3.5%, that first year, you go from 200,000 to 207,000. But now the next year, you're earning 3.5% on 207,000. So now it's 210,000, almost 211. And then the next year it goes up again. Actually not 211,000. It's going to be like over 214,000. And then the next year it probably goes up to about 222,000. And it just keeps going like this. That's why. By the way, the break even, if you have a 4.5% mortgage, you earn at least about 2.2% on your money, you will at least break even because of compound interest. Now, we're not even talking about like, I haven't even mentioned like 4.5. I think 4.5% you actually net by about over $400,000 net between the difference between what you paid versus what you earned. This, by the way, when I first learned this, it wasn't even until like 2009 when I first learned this. This blew my mind. And I hope it blows yours too, because even if you just took this at face value about your mortgage, not paying off your mortgage early, this could mean hundreds of thousands of dollars, because 3.5%, let's admit it, anything that Lane is throwing your way is not 3.5%. It's way more. It's the difference of hundreds of thousands versus millions more, right? It's huge. This also applies when we're dealing with life insurance too. I thought I saw comment or chat here, but I guess not. So never mind. I can't pull it up on my screen.
I will get to it at the end.
Cool.
There's a question about 401ks and stuff.
Oh, yeah. All right. That'll be a fun one. So here's how it works. And I have my wife help me with this because I'm a completely idiot when it comes to computers. So I just created this for you guys tonight. This is how it works. You're putting in money, right? Here on the left, you see we got money. You're putting this high cash value policy, this what we call wealth formula banking type policy, right? It's a life insurance policy you're putting in. Like I said, most of it's going to cash. Now it's earning tax-free dividends, of course. That's what you see there on the bottom. But what we do is we're taking a loan from the policy. Now, how do we do that? This is where it gets cool because, see, you can withdraw money out of a policy just like you do with a savings account. But remember, it costs you interest. It costs you the ability to earn money when you take out money. Because, for example, you take out money, put a down payment on property, you got to take the cash flow and build it up slowly over time, right? But here we take a loan from the insurance company. It's a separate loan. Your money's still in there compounding the full amount. You just take a loan like it's a line of credit, just like a home equity line of credit against your mortgage or against your home, right? You take out a line of credit, and as you pay it back, you start paying it down, but you can still reuse it again. The difference is when you take a loan from this, there's zero record. This is not on your credit. There is no minimum payment you have to pay every month. In fact, you don't have to pay it at all. The only time you have to pay the loan back is by the time you die. That's the key. But the way we're trying to show it here is, obviously, if you got a cash flowing investment, you borrow it from the insurance company, and you usually will borrow at a slightly higher rate than what they're paying you. But because of what I just showed you, because of the compound versus simple interest effect, you end up winning versus just liquidating a savings account. You come out better. And I'll show you an example in a second. So you borrow from the policy, you put in the investment, that creates cash flow. So, and then that cash flow goes back into the policy to then do it again. So the cash flow is going back to pay back the loan, freeing up more of the cash available to go invest with again. And you keep doing it over and over and over until what ends up happening is you're starting to accumulate interest in your policy, in your life insurance policy, and you're still cash flowing what you would have been cash flowing anyway in your other investments. So you're now creating money twice. You're creating extra dividends, extra interest from your policy, tax-free interest, and you're making money on your investments like you would have normally anyways.
I call that, if you go back to the last slide, Chris, I call this, I call it like the investment is like the gun, right? But the high cash policy with that recycling is kind of like the silencer in the gun. It just makes it better. Yeah, it's not much. We'll get into that, I'm sure. But it's just why would you not get a few more percent points on top of this, which you're already doing?
Exactly. I talked to an investor today. He said, okay, I'm starting out. I know nothing about life insurance, but I know you guys are excited about it. What does this really mean? And I told him, I said, hey, what do you normally do? He's like, well, I just cash out money from my bank, use that to go and invest, and then I get the cash flow. It's like, cool. Yeah, you do that. And then you have to take that cash flow and you put it back in your savings account, right? He's like, yeah, of course. Perfect. Well, that's great. Now you just have to wait forever for that money to build up. If it's saying it's like $600 a month you get from that investment, it's building up over time. Finally, when it's got to tens of thousands of dollars, you're actually earning some kind of interest. But in the meantime, you're earning nothing, right? You've lost the ability to earn interest. There's an opportunity cost there. I said, we're just doing the same thing, but instead of putting it into your savings account, we're putting it back into the line of credit with your life insurance and then using it back again. And you can use it whenever you want. That's the great thing. So let me give you a real life example. So this is a property. And granted, this is a great cash flowing single family rental here. You probably won't find these kind of deals very often anymore, but this was about 6 months ago when I found this property. It was a Missouri property, $33,000 you'd have to put down on it. The cash on cash, the cash flow after expenses, property management fees and everything was just over $600 a month, but I brought it down to just being even $600, right? So normally you would say, okay, either I take money out of savings or I borrow the money, right? Now, if you took the money out of savings, the $33,000, that $600 a month is going to take time to build up. So after 5 years, in this scenario, you'd actually get the money back. So after 5 years, that $600 a month becomes $36,183 in your 0.2% savings account. So that's what it accumulates to in about 5 years. So you basically earn an extra 8% in 5 years because of interest due to that savings account. So, okay, not bad. That's the normal situation. Maybe better because I know most banks I'm working with are at 0.1, 0.15% right now, right? So again, I like to play devil's advocate against my own point. So 36,000. Now, what if you use life insurance? What if you borrowed from it and then use the 600 to go pay back that line of credit? Here's what happens. Here's the net return you get. Here's the net you have. It's because it compounds, and then you have the loan. When you factor it all in, you have 39,000, about $600 total. That's 118% return. What does that mean? That means you just profited and you just pocketed an extra $3,400 doing the same exact thing as this scenario. The only difference is that you use your life insurance to borrow from instead of using your savings account. That's it. Pretty cool, huh? That's about a 10.2 cash on cash return in those 5 years. Now, what would that same property, say you actually held on to it, you didn't reposition it, held on to it for those years? Guess what? 10 years? That now becomes $17,321 more in the life insurance than you would have made in the savings account. That's almost 52% return there. And then after 20 years, now you've made an extra $83,000 from just 33 grand that you put on a down payment of property that you use your life insurance on instead of your savings account. That right there is like a freaking nice duplex right there for you. Wouldn't you agree, Lane?
Yeah, so let me just pause right there, and just in case we forgot somebody on the bus. So what we're doing here, you're getting your life insurance policy, you're getting that, Chris is making it so you get that high cash value. So you can go and you can take that money and you can take a loan from yourself and then go and invest that money. And then if you go back to that other diagram, that whole cycle thing. So this is what you're augmenting your investing, because you're essentially using your money in your life insurance cash value to go out and do whatever you want with it. You can leverage it in Fannie Mae loans. You can put it in a syndication. You can do whatever you want with it. But you're always making that delta, that spread between the cash that you're making with your life insurance and then the cash that you're borrowing from your life insurance. Maybe it'd be good to talk about some typical rates, Chris, that you're seeing today. I mean, I know it always changes.
Rates of interest rates, you mean, or what do you mean?
What are the typical rates that the life insurances that are paying out that they're pretty stable, and maybe you can talk about that also, and what are you borrowing this stuff at, so you can kind of illustrate the delta, and that's the magic behind that stuff.
Yeah, absolutely. Now every company is a little bit different, but for the most part, I mean, the interest rates, the dividends they're paying right now they're actually less than they've been for most of history. Because of the Great Recession, I have one company I'm using. They've locked the rate at 6.35% for the next for the last 9, almost 10 years now. And so it really just depends. But I'll tell you, net return, right? The net return has actually been roughly about, if you do it this way, about 4.5% or so is the net tax-free cash on cash return on this policy. So that's what it is. The loan rate, the cool thing is the loan rate, and I actually have one company I've been using lately where the loan rate is the same as the dividend rate. So they'll lower the dividend rate on the money that you borrow to 4.25%, but they also charge the interest of being 4.25%. Now, the reason why this is so important is because some people will say there's types of life insurance policies where they do a wash loan where it negates itself out to a 0% loan. You don't want that because, again, you've lost the ability to create compound interest. It just means you're not making any money. You're not losing any money, but you're not making any. You actually want them to keep compounding your money while they're charging you interest, which is what whole life does, not universal life and those kind of things. So yeah, the earning on this, roughly, if you're looking cash on cash return, first few years, there's the costs, right? And that's the thing we minimize the most. So you'll have a negative return in those first couple of years. But after that, then it starts growing pretty drastically. That's where you start looking at again, like I said, cash on cash, it's roughly about 5 to 6% after that point.
Yeah, so just to illustrate, I had a question here asking about the, you're making a return on the investment, or the you're paying a loan to yourself. You're paying that rate out, but you're also making a dividend on the cash value. But the cash value is tax-free, right? And that's the difference. You're making tax-free growth on that, but you're also deducting the dividends or interest rate paid on the loan, just like you would a HELOC. When you take a HELOC out, the interest you pay into that, you're deducting it, or you should have your tax accountant if you guys need a tax accountant.
Yeah, we haven't talked about deducting off your taxes too, on the loan interest of the.
And that's where we're talking about this gap is.
Yeah. Well, and so yeah, there is a premium to keep the policy open every year. So I'll address Matt's question too. That's true. The thing is, because we're stuffing in so much more money than what's required, it like in my scenario, if after it's like 2, almost 3 years, if I would have had a policy like this, I could have gone like 3, 4, 5 years, maybe longer, and not had to pay a single dime into it, and would have kept going, because even then they still borrow money to then, remember, the insurance company gives you a loan. So if they give you a loan to pay your premium, they put it right back in your cash value. And the way it's structured is by the third year, like you put in, like I had somebody who put in 50,000 their third year, but the dividends was an extra 4,500. So even if they couldn't make the payment, the thing is that even if they had to borrow 50,000 to put in, they still made 54,500. So they basically made 4,500 for free because of that. So yeah, it actually keeps it open. So even if you hit crappy times, you can adjust it and make it lower and do all kinds of stuff, make it easier. Yeah, you can use, there's cash value to pay the premium, but basically they're loaning you money to give you the premium. Now answer HC's question, because this is key. He asked, like, is what you're earning on your, basically when I'm talking about earning is what you earn on your investment versus what you're paying for the loan on the policy. The answer to that is you're still earning everything on your investments, and you're earning money in the policy, and just what's inside the policy, the compound interest versus what you're paying on the loan, because you're flowing the money through, the cash flow through, and cycling it back out to go and invest again. That's still earning interest there. So life insurance is earning interest and dividends tax-free, and you're still earning the same amount of cash flow on your property. So it's not like you're negating, like, oh, the property's paying the loan off on the insurance. No, like it's actually in addition to the money you're still earning. So hope that answered your question. That's the thing that blows people's minds. So the interest rate for borrowing, like I said, like it just depends on the company. Like one of them is like 4.25%, while they're also paying you 4.25%. Most of the time, depending on which company you look at, it's usually like 5 or 6% for a loan rate is pretty typical. And then their dividend will be just slightly lower underneath that of what they'll pay you. But again, same thing, compound interest still beats the simple interest they're paying you on the loan, so you still come out ahead if you do it right, if you're flowing the cash flow through it.
Right. And like I said before, you're deducting the interest paid on the loan paid to the insurance company. And yeah, that's what creates that gap. And this is nothing like spectacular, right? This is just a little bit better than what you're getting. But these little corrections are what adds up. Another question we had here, Chris, was, is this the same as if we borrow from a 401k or solo 401k? So if you're one of those unfortunate people who have socked away a lot of money into their 401k and only to be saved by a solo 401k, which you need a certain custodian. I got a guy who does that, and I don't know if you can do it too, Chris, but I mean, I always recommend keeping it in the solo 401k, but I personally don't put any more money into my Roth or any of those QRPs.
No, I mean, you definitely don't want to be putting anything in IRAs, 401ks, things like that. 401ks loans are a little bit different. One, they make you pay back on their terms, right? People say, oh, I'm just borrowing my own money. That's only partly true. It is similar in the sense of like an insurance company where they're actually lending you the money and they're just using your cash that's in there as leverage. Few things that are words of warning though with the 401k. One, I mean, you're still having to pay that money back. The cash flow, the cash on cash return you have to get on an investment's pretty high. I had a guy who actually said, hey, I can borrow $50,000 from my 401k, but I'm gonna have to pay back $520 every paycheck, or just over $1,000 a month. I'm sorry, like even if you use like AHP or something like that, where you're getting paid 1% a month, that's only $500 a month cash flow. That you still have to make up the other $500 a month to put back in that 401k, right? Plus, this is worse. If your 401k loses money because it's invested in the market and the market goes down while you're trying to pay back the loan, now it's like a double whammy because everything is amplified. I mean, that's why I don't like the match, because if they throw in a match along with your money, if it loses 20%, now everything loses 20%, not just the money you put in. It's like amplified. It's like when you do stock market trading, which I used to teach people how to do. Like, if you try to borrow money and then you lose money, they're like, oh, I'm calling that money back. You got to pay that money back and you get left whatever's left over, if anything. You actually get double the losses. Same thing can happen with the 401k and when you do a loan that way. So it is a little bit different, and the loan terms suck, really. life insurance, like I said, you could pay it back monthly. You could pay it back never, although it will compound against you if you never pay it back, right? But at least by death, the death benefit will pay back the loan, and then whatever's left will pay back to your heirs. But I've had people where if you're doing a bigger deal, maybe the deal doesn't cash flow right away. It'll take 6 to 12 months. Well, great. You can make a payment. You can pay some of the interest or none of the interest. But when it finally does pay, or maybe you get a big lump sum, because it's kind of like a capital gains deal, as Kiyosaki would call it, you just take a lump sum and pay off the loan or pay it down or whatever you want to do. The thing is, it's so flexible. You really get to choose how you want to do it. And the way we structure it is try to make it as easy as possible.
The other question is, I don't know much about 401ks because personally, solo 401ks, because I cashed mine out. But the question was, wouldn't they be the policymaker? Wouldn't they dictate how they pay it back?
No. They ask you how you want to pay it back, and you tell them. So if you if they say, hey, you want to pay this back monthly, you could say no. Just say, I'll just pay it back whenever I feel like. Or you can just say, hey, let's just do X number of dollars per month. And so if you do have a property where or any investment, you say, hey, I know I'm getting paid this much per month. Cool. We'll just put it back in. You would have put it back into savings anyways. Just put it back towards that loan. And then that's just what you do. So you set the terms. You have control, not the other way around. Mark asks, what is the interest rate cost of borrow? Is that what you're going to read, Lane?
No, I think he's asking a funny question. No, do not buy jet skis, saunas, or fancy cars with your cash policy. No, do that.
Well, you could. Here's what I wouldn't say that for sure. You can purchase vehicles. And I think he's referring to Nelson Nash, the example he uses where you become the bank, right? Here's what I'll say though. Like, for example, right now a car loan is roughly about, 2 3/4 to 3%, just depending on your bank, your institution, right? I tell you, I would not borrow from a policy to do that. I would rather save that money to go use for investing purposes than to do that way. Because the reality is that you're still being charged interest on the actual policy, right? So if you're charged even as low as 4.25% to 5%, you can get a much better rate through the bank. Same thing with a mortgage. You can get better rate through a bank doing it that way. So I actually recommend you do it. Yeah, 1.9, Mark can get 1.9 for a new car. Awesome. Do that. Like, go for the lower rate. Now, here's the only time you might not care is because maybe you don't want to be stuck every single month paying back to a bank. You don't want to be told that you have to pay a certain amount of dollars to do it. Or maybe your debt to income ratios are really close, so you have to kind of be a little creative so you can keep doing your investing. Usually that's not the case. But if it's for peace of mind purposes, maybe you do it. But I personally, I love to leverage the bank as much as I can, especially for the low rates. The expensive stuff that you might use a credit card for, or things you can't borrow money for, like a down payment, that is what I use my insurance for. Hope that makes sense there. And Mark, the same interest rate, cost of borrowing, the interest rate, just like I mentioned, 4.25%, 5%, just depends on the company. The one I like to use is 4.25%. Is what the rate is at right now. Good questions. All right.
And so just, something on my policy. I guess I'm probably younger than most folks out there. And that's, people will say, oh, I'm too old, or I smoke, or I have cancer, or whatever. And I can't get, it's going to kill my cash value up front, or I'm going to pay a lot in fees. Just using me as a high end data point, and I had a couple other people go through this too, and they were like 50 years old. They didn't have a pre-existing condition or anything like that, but they're just older. It just didn't really seem like too much of a difference. Out of $50,000 the first year, my cash value was like 40 or 35, something like that. And it really wasn't like, you're talking like a couple grand, $2-3 less for the other end of the spectrum, or the middle ground. It really wasn't that much.
Yeah, the nice thing is it's guaranteed. Even if they don't pay their normal, if they just pay the guaranteed rate, which is like 4%, great. That's awesome. It's going to keep going.
And you mentioned something to me that really made a lot of sense. Like life insurance companies, these are the most stable companies. And these are the institutions that all of us investors like bang our head against the wall. These are the guys paying 6.5 million when I'm like underwriting a deal for five or 5.5.
Mm-hmm. Yeah, I'm glad you mentioned that because somebody else brought that up to me just yesterday, and I kind of forget about it because I just automatically assume, hey, life insurance is safer than savings accounts. But you think about it, a bank can leverage 10 times. They can arbitrage, create fractional reserve banking, right? They can leverage 10 times the amount of money that they have in reserves. And then we saw some cases with like the bigger 5 banks that we had to bail out. They were leveraging 40-1 when we had to bail them out. They got Congress to pass to do more. So we already know FDIC, that's supposed to protect our money in savings accounts. We already know that if banks were to start failing, there's no way they could pay all that money back to us. The thing with life insurance is that life insurance companies cannot leverage more than what they have in cash reserves. So if they've got $1 billion in cash reserves, they can only leverage $1 billion. They can't loan out more. And they're also legally required to buy what's called reinsurance, which is basically insurance for insurance companies. So if they ever go into default, like if they ever go out of business, the reinsurance will pay out so that some company can go and buy them up so that your policies and your cash is secured. So that's one thing that's really cool. And so your money's safe for actually life insurance. And I'm not even talking about from taxes and from creditors and lawsuits, but it's safer even from the sense of recessions or even depressions, things like that. You're much more risky to keep your money in the bank. And by the way, I actually love to keep my cash reserves, even the emergency reserves, most of it in life insurance, a little bit in the bank for like today you got to get to, but you can get money from your life insurance, but usually within like 3 to 5 business days, you can get money out of your life insurance policy for whatever emergencies too. So a lot of times that first year, I just tell people, hey, your emergency reserves, put it in there anyways, get it out of the way from taxes and make whole rates of return, not point nothing percent that you get taxed on like in a savings account, right? So
like I used to tell people, like, oh, use your Roth IRA as a forced savings account because you can pull out the contributions. But yeah, exactly the same premise.
yeah.
Let's catch up on some of these questions.
Yeah, a bunch
I don't
just
know
came
where
in.
Matt's at, but his iPad is asking a question here. Can we use checkbook control on this and control it that way? I mean, me personally, I just call my guy up and just goes in order. You don't want to be doing this all the time. But what's your thoughts there, Chris?
See, sorry, I was trying to see which question. There was several of them. Which one was that one again?
Do you have checkbook control on this stuff?
Oh, yeah. Yeah, I guess I kind of answered that a little bit. Like you do have control. I mean, you can't just write a check from it, but you can just call them up and say, hey, I want, and you can tell them either withdraw the money or borrow, which we usually recommend borrow, right? Hey, I want to borrow $50,000. Well, like, okay, cool. What account do we send it to? And they can usually electronically transfer it to that bank. And like I said, it usually takes up to about, plan to up to about a week to get that money transferred over, but it's usually pretty quick. Way faster than if you're trying to cash out your 401k or transfer that over to a self-directed, which might take a couple months because Fidelity doesn't like to let go of their money, so much faster. Let's see. Oh yeah, Mark asked a good question. Do they invest in securities as well? No, they do usually invest in bonds, mortgage-backed securities, things like that. Usually much more conservative type funds that they're doing. Good news is whenever you see interest rates go up, usually your dividend rates go up as well. So obviously where interest rates are like historic lows, that's also why their dividends are lower than they have been. I remember actually in early 2000, it was right around double-digit dividend rates they were paying back then.
So my 4% will go up, and then if the interest rates go up.
Yep, interest rates do go up over time, but they're very slow to adjust. They don't like to. At least a lot of the companies I use, they're not quick to just throw numbers around. They like to do it very slowly. So even if things go down, they tend to do it slowly as well.
Yeah, and then homegirl Lisa here, she's always asking about her full solo 401k, and maybe here's my commentary on the thing. It's like. And a question for you, Chris, like if you got all this money tied up in the solo 401k, shouldn't you just cash that sucker out and stop screwing around with this thing with the solo 401k? Like, what's your thoughts here?
It's tough because it's always case by case, like if somebody's getting near retirement, like I have somebody right now, they're 55. It's like, okay, we can just put that into like buying life settlements or something. And then over time that we can cash that out later. But if you got a solo 401k, can you transfer it into life insurance? The answer is no. You cannot take like IRA or 401k money and just transfer it over, because it'd be like trying to transfer it into a Roth IRA. You're going to have the hit, tax hit, right? So it has to be after tax dollars you put into life insurance. Okay. No, okay, it's not 100% of the time has to, but there's corporate owned life insurance you can buy through your corporation stuff. That's separate. For your own personal policies, no, your 401k can't buy whole life, but in that case, you'd probably just cash it out and take the penalty and the hit, and then you can use that money to put in the policy. Same thing with somebody asked about HELOC too. Would I use a HELOC? Not necessarily, because you still have to make payments on that HELOC, but you could. If it's a HELOC, usually I just have people go and invest in properties using the HELOC, and then again, using the cash flow to try to help create that back. So I use that more like a bank type policy. The only thing with a HELOC is just not as good. It's a HELOC. If it would be cool if your property would always appreciate, because that would be like the life insurance, because you have a HELOC type of thing, but the difference is you're earning tax-free dividends on top of it, not just paying interest back to the bank, right? Roth, you just wouldn't transfer it in and put it in Roth status, but yeah, Roth money, you can always put that in, So time for me to take my vitamins. So, Roth, again, just using cash is after tax dollars you use to fund the life insurance. But yeah, you can use those things, but again, it's case by case, depends on the strategy. It could work, but as a blanket statement, oh, and also laying on top of your solo 401k question too, whether to cash it out. Hey, the thing is, if you're trying to create cash flow and you're trying to make a very short-term goal to do that, you can't do it with your 401ks or IRAs.
Yeah, get out of that sucker.
What's that?
Get it out of there.
Yeah, that's a case, that's where I've had people where they're saying, hey, I have a 5-year retirement plan. Oh, cool, you're 45. Well, that means you got 15 years if you use it in the solo 401k or something. No. Maybe it's worthwhile just to take the hit. I had one client, he actually decided after he looked at the pros and cons, he cashed out $200,000, and he was already in the highest tax bracket, but he cashed out $200,000. He's like, I don't care. I'll take the hit this year. I'll pay it back in taxes next year. The rest of it, I'm going to go ahead and make some cash flow from it and start, be able to get to the point where I can quit my job in the next couple of years. So, okay. So let's see, Ray asked a question. Let's see, do you have a preferred custodian or provider for this policy? He has an IUL with Transamerica. I know that one very well because I used to sell those back in the day. Can you transfer the policy? Yeah. So, Lane, obviously, with real estate properties, you can always do a 1031 exchange, right? We transfer the equity from the property you sell to the next property and avoid taxes and stuff. Same thing can happen with life insurance. It's called a 1035 exchange. And so you can roll any cash value. Hard thing is your IUL policy, there's a cash value and cash surrender value. One reason I don't like the index universal life policies is because they do have surrender fees on them. And so even though they can have high cash value too, the thing is you can't touch that cash. They gear it to be 10 or 15 years before you can really start touching the full amount of money in there. And if you're an investor, you do not want to wait 10 or 15 years to do that. Not to mention, when you borrow from those policies, there is no compound interest either. So there's none of that compound versus simple interest benefit that you get where you can actually make more money. So you don't get that benefit. So yeah, I know that. In fact, I know that very specific universal life well because I used to sell that very thing. You just can't do the same thing. But the good news is, yes, if it makes sense, if the numbers make sense, of course, you can take whatever cash surrender value is, directly transfer it over with no taxes, no anything, transfer it to your new policy, and that already starts funding your new policy. So you can get a little extra super boost on there, a little extra supercharge. So yeah, great question, Ray. Thank you. By the way, Ray, good to hear from you. I've only known you through Facebook.
I got another question. This comes from Lane here. So yeah, Liquidity, a lot of these large multifamily deals, for the partnership team to qualify for a loan, and you need liquidity. Does my life insurance policy count as that?
Yeah, that's a great one. I used to do mortgages, and on a mortgage application, you have two assets they look at: liquid reserves, like liquid assets, and illiquid assets, right? Or non-liquid assets. Non-liquid assets would be like your 401k and your IRA. When you're trying to do a loan, they really don't count that as an asset that could be considered like cash reserves. but your checking, your savings, your money markets, and your whole life cash value is considered a liquid asset that helps you qualify for a loan. And so, like I said, you could have almost nothing in the bank, but still by having the money in the life insurance, just by reporting that, and even if they ask you for proof, great, you can just show them a little document from your insurance company saying, here's how much cash I have, or here's a statement, there it is, and voila, you got it. So yeah, you can actually use that to qualify for mortgages. It's awesome.
And something like the AHP wouldn't count, right? I mean, that's not liquid.
Yeah, that one wouldn't count as much. Yeah, that's more of an illiquid one.
So that's a downside to that.
Yeah, cash flow good, but yeah, it doesn't count as cash reserves.
Right, but for a lot of people who aren't going, bigger units where you need that liquidity, it's not an issue at all, I think.
Yes, exactly, not at all. A great question from let's see, who was that just up there? W-2 job for Matt, right? So he has a W-2 job, not sure what his budget is. What's the yearly premium you can start out with? Can you start with a lower premium, and then is there a maximum amount you can contribute? And what point do you buy a second policy? So a lot of questions there. Here's what's cool. We can structure this however we want. Whether you're putting in $500,000 a year or $5,000 a year, you can structure this however you want. The thing is, all I have to do is I do pretty much almost the same kind of spread. Now, granted, the more you do, there is a little bit of more cash that could possibly go into your policy. Like I had a guy today where if he put in $100,000 a year versus $50,000, he does actually break even a little bit faster, at least a few months faster than he would otherwise. But you can start with as little as possible. And now if it's really like, if you're like tight, like paycheck to paycheck, we can always buy what's referred to as convertible term. Make sure it's with the right type of company. By convertible term that you can convert at any time to a whole life policy down the road. So you can start out small. You can say, hey, all I can do is I can only max out 10 grand a year. Cool. All right. Well, we'll make sure that in the first year that the fees are cut back enough that you get at least 7 or 8 grand in there. Right. And then after that, if you have more cash flow or as other investments start paying, the cool thing is then you can actually say, okay, I got this other term policy I got here. We can convert pieces at a time. You don't have to do it all at once. You can convert a piece of your term insurance to say, hey, if you have $1 million term, take $250,000, convert that to whole life, and boom, start the whole process over again. And so the way I like to structure it is I'd like to max out whatever we do right away. So you have max cash value right away, no matter what you do. And so, yeah, you can convert over time. And even if you happen to have so much cash that you max out every policy possible, you can buy on your wife, you can buy on your kids, you could buy on other extended family members, even employees or partners or whatever. Anybody that you have a possible connection to, like from a business or a financial connection, you can buy a policy on. So the good news is you probably will never run out of options. You can always do something.
Can we explain what like Walmart was doing or all those companies?
Yeah. So GE, Walmart, so I'll use GE because GE is an old example. What they would do is they would have their pension plans. Remember those days when they had pensions? I sure didn't see those days. So to pay their pensions, what they would do, they would buy policies on those employees. And then what would happen is they would pay from the cash value of the policy. So they'd be funding their own whole life policy to pay that pension. Here's what's cool though. When that guy died, that man or woman that worked for that company, when they passed away, obviously the pension stops. But now because they own the policy, the death benefit then paid to the company tax-free. And then they can now use that money to then fund their pension plan, right? And so what ended up happening is, so even let's say they had $1 million policy, they paid out maybe a couple $100,000, but they died, boom. Not only they get their couple $100,000 back, but they probably made even a few $100,000 more. And then they can do the same thing again, and they're buying policies on their employees. And this is exactly what Walmart did. Walmart was buying policies on everybody, and they didn't even need their permission, really. The problem was that a lot of people got ticked off because when they found out that Walmart was banking on their, even past employees, because you can keep it even if they quit, you can still keep the policy going, right? So even when after those employees quit, family members would find out that Walmart was getting paid on death benefits, and they're saying, hey, that's not fair. You're banking on their death. And so they put a little bit of restrictions on Walmart after that. But yeah, you can definitely do that kind of thing. Let's see. So Mark's asking like Guardian, Penn Mutual, any comment on these or others, like company-wise? Guardian, strong company, not cheap. I don't like them. Penn Mutual's great if you structure it right. I just saw somebody today who did a Penn Mutual policy with someone else who does a really good job. I found out that he was still overpaying about 10 grand a year compared to what I could have done had he done it that way. So hard thing is that even with agents, even if they have a good company they work for, doesn't necessarily mean that they're going to do what's in your best interest. They're going to do whatever they feel is going to pay them enough money for it. So, and most of them, I had to like really get into these companies and say, how can I max this as much as possible? I'm an investor. I want to max this as much as I can and get as much, basically as little cost as possible. I had to like really like dig in and research even to be able to figure out how to structure it just right to do that. So restriction on loans. Yeah, the restriction is you can only use about 95 to 100% of the loan of the cash value you have in there. That's about it. So unlike a 401k where it's either 50% or 50,000, whichever's less, right? Cash value, if you've got $1 million in cash value, you could probably loan out at least $950,000 you could have out there being loaned. So they usually let you keep a little bit in there. Just they want you to keep a little spread in there just to be safe in case you lose that money for whatever reason, right? But usually you can use about 95% or so of the cash value you can take out as a loan.
Yeah, so this is just use me as a data point. I put 50 grand in, and today, or right when I put that in, I could take out 35,000 or so, so about 70% of it. But as the years go by, I think year 3 I can get 90% of that.
And
then year 6,
by the end of the year, yeah, if you're putting like lots of extra like we have you guys do, yeah, by the end of the year, like little bits free up like every month of what you can borrow. So they kind of hold on because they're afraid of people being terrorists, basically, right? I mean, they don't want people that are like, trying to do money laundering, like stuffing money in, which by the way, money laundering is common. Even with life insurance, they'll buy huge policies and then they'll try to cancel a policy, get the cash back out to launder it. So insurance companies are a little bit leery about, hey, we don't want you just like putting the money in and then this same month trying to pull the money out. They're going to get a little bit skeptical, right? But technically you could still do it. They might hold on to a little bit. They might say, hey, you can access maybe 70% this month, but as the months go on, even within that first year, they might get up to like 90% of whatever the cash value or 95% of whatever the cash value is in there. They'll let you borrow.
Right. So here's a practical example. Say you have like 200 grand, right? And you're going to put a little bit into this life insurance because like every year you're going to be spending like 50 grand on some kind of a syndication. So at year 3, you're going to get a lot of money back coming back at you, about 90% of what you're putting in. So this is a good way of, you need to think about strategically, map out your years. And, we had a question earlier about, well, how much should I put in? Well, depends what your goals are, right? Like I'm a super active investor. I'm trying to be very optimal with it. And for me, not going full all into life insurance with this stuff isn't the right best thing for me. But if you're more of a passive investor, more the typical, person that listens to the podcast, this is probably pretty good for you.
Yeah.
You're not super optimized.
But you still got leverage. Yeah.
Right.
Absolutely. Yeah, it's a great idea. See, other questions came through. Let's see. Ray asked about, the idea of a MECH. MECH, all that means is modified endowment contract. That's basically if you put in too much given the amount of death benefit, it does become taxable like an IRA, like I mentioned earlier. Everything I'm talking about here is staying under that, so you stay clear of taxes. So you just keep it tax-free. So like I mentioned, like in that first year, we try to get at least about 75% of whatever you put in that first year to be right in cash value, to be available there. That's the goal. In some cases we can do more, just depends on person's age and death benefits and things like that. But that's the whole goal. And that 75% is about as much as we can get in without it becoming taxable. And yeah, basically that's the best tax-free legal way we could do it. That's the lowest cost you can usually do in that first year. But the nice thing is after the first year, that's the most expensive time. Once you hit that third year, like you were saying, Lane, everything you're putting in, you're getting more in dividends and more cash value than what you're putting in. So you're getting almost an extra 10% on top of whatever you're putting in by that third year, if you do it right.
And about six years in, you're at pretty much full strength. You got 100% or pretty much 99% of that you can use.
Yeah, exactly. Another question was that, is it better to put in a bigger amount, and what's that sweet spot? Also, like, is it 75% of income, that kind of thing. It really depends on your cash flow. with between your investment cash flow and your personal like extra money you have left over, especially if you hopefully stop contributing your 401ks and IRAs and stuff, and you have that cash to use, save, I would say use a good chunk of that, but probably not everything. You know, you want to make sure you have a buffer. So say you have an extra $1,000 a month you could put away. We might say, cool, let's set up a policy that maybe is like $700 a month or $600 a month, right? At least in the beginning until you get cash flow up some more and that kind of thing. And so really it's not about, the good news is that if we know how much you're willing to put away, to put in, we can reverse engineer it and figure out, okay, here's how we get the max cash in there for that situation.
And the one term that I wanted to bring up is like an EIUL, which I had the experience of, talking with this to other actual insurance providers, and, pretty sharp guys, but they just don't get it. They're not real estate investors. They just don't get it. They're like, oh, why do you want to get 4% out of this whole life infinite banking thing you're talking about, where you can go with the EIU and get a higher interest rate? Don't you want higher? But I'm like, no, dude, like you don't get it. Like we're doing this for liquidity and the sheltering, right? And so if you do get a higher rate, like 6-7%, as opposed to the 4, how does that screw up your cash value? It's gonna be a lot lower. Like I guess like how low? And maybe you mentioned that, but I just don't understand the EIULs too.
Yeah, EIULs. I mean, it's like the thing that makes them work. Here's the one difference between them and whole life. So whole life, we talked about already. Like you have the cost up front, but then especially the way we do it, like after the 3rd year, the costs are gone, right? Like you're earning more than what you're putting in. With an IUL, they're kind of like, they're like the Lexus compared to the Toyota Camry. Like the Toyota Camry is the cheaper version of the Lexus, right? Same exact car, same parts, same chassis, but you pay double the price for the Lexus. The IUL, the Index Universal Life, is the Lexus. It's basically term insurance that renews every year. So every year, if you think about term insurance, it gets more and more expensive as you get older, right? So the costs in IUL go up every year. And so what happens is that, and I mean, not to mention the borrowing aspect, which you don't really get any compound interest effect from. On top of that, you have costs that go up every year. So it gets more expensive over time, not less. I know I'd rather be less expensive over time, less expensive as it gets later than more expensive as it gets later, right? So that's a big difference between the two.
Well, why wouldn't we do an EIUL with, taking out the cash value and borrowing that? Like, why wouldn't you do that?
Well, because what they do, it's a little bit different. So let's use that same 4.25%, right? Like, you remember the company I mentioned where they pay you 4.25%, but they also give you a loan rate of 4.25%. Well, your money's still compounding at that 4.25%, right? While you're paying the 4.25%. In IUL, if it's 4.25%, they just subtract it from each other. So they'll say, okay, well, you're getting credited 4.25%, but the loan rate is 4.25%. So really, we're just giving you a 0% loan. So they're just giving you a 0% loan. There is no compounding. It's just a 0% loan. There's no cost, but there's no interest on it either. You're not gaining any interest. So it's just a flat, there's no real benefit for borrowing from it because there's no compound interest effect there. That's why. I'm just reading one of the questions. So my wife loved her old Vitamix. We had to sell it this last year when we got a Blendtec. So sorry. How much money per year would be expected for super healthy, totally ripped 8-packs on top of 8-packs, 33-year-old male who drinks juices out of Vitamix daily? That's I love that.
Well,
for a 33-year-old, I mean, it depends on really the death benefits, what determines how much you can stuff in. So like a 33-year-old, normally buying $1 million whole life policy might cost like probably about $8,000 for a totally ripped, extra healthy guy, right? But the way we would do it, we would probably stuff in at least 4 times that amount. So you could probably, for $1 million policy, max out like $30,000 for $1 million policy. But here's the cool thing though, is that whatever you want to do, like whatever you want to have available. So like, for example, somebody told me, hey, Chris, I want to make sure $50,000 is available in that first year. Okay, cool. Let's make sure we put in 65,000, right? In that first year, so they have 50 grand available. So it really, you can make the cost whatever you want. We can do 100,000 policy and max it out, right? And it could be like a couple thousand a year. I mean, it really doesn't matter. The numbers are pretty much the same. We're going to try to get as much in as possible, So that's the cool thing, is like, it's whatever you want it to be, whatever cash flow you want. That's the thing.
Yeah, and I think, in this seller's market, I always talk about, there's not really many deals out there. I mean, a lot of us there's so much money out there, and a lot of us are just kind of like, well, what the heck do we do? Because a lot of the investments, the turnkey stuff, it's not cash flowing.
Right.
You ask the question, well, what else is there better than that?
Well,
it's an option.
Yeah. Well, what a great place to store the money. Like if you're trying to figure out like, hey, I'm waiting for the right deal, where am I going to store the money? Hey, let's store it in a place where you earn actual whole percentages returns, tax-free, which by the way, when you factor in even like 4.5% tax-free returns, that's usually doing just as well, if not exceeding what a mutual fund does after you pay taxes on it. Especially when you factor in fees and taxes and everything, a lot of times you can usually at least match, if not beat, what you would do in a mutual fund anyways. But the difference is you can get the access to that cash whenever you want. So at least it's doing something while you're waiting for that right deal to show up, right? So yeah, it's a great place. That's why I want you to think about it. It's really a place to store money, like a savings account, but it's tax-free, liability-free, and you're also getting a much better return than you would sit in a savings account anyways.
All right. Well, if there's no more questions, I'm going to close the call because I have somebody waiting outside to buy my couch. Because you guys have heard the theme song a bunch of times. Well, I'm finally moving back to Hawaii and selling all my crap. So
that's right.
Matt's iPad is at it again. When talking to agents, what are the red flags?
Ask them about this. Ask them what they think about infinite banking. I will tell you, most of the time, they won't like it. That's pretty common. And I'll also tell you, too, that even if they do like it, they don't do it like I do. If you're lucky, you'll have 50% of the cash value available in that first year, not 75. Most will not cut it back that much. So even the ones that talk about doing infinite banking, that's why I call it wealth formula banking, because it's very different. We're not all the same. We do it very differently. And so even infinite bankers, those people that do infinite banking concept, even then, most of those people won't cut back the commissions nearly as much because that scarcity, they do it. They're not like me where I'm retired. I'm actually doing this for fun now. Like I actually talked to somebody, I was like, I'm getting bored. I'm working 5 or 10 hours a week just consulting people and stuff. I need something else. And this has become fun for me. I've been insurance licensed for 15 years, but finding better and more effective ways to do it from an investor perspective, which agents do not have, that's key. And so if you've got questions, you can always email me, chris@moneyripples.com, MONEYRIPPLES.com. And you can ask more questions that way. We can always do that later. But, again, I appreciate the questions you guys have had. You guys are sharp. I love the questions. They're perfect. They're exactly what they need. And I hope it was open your world to realize that there's a whole new world, just like you learn there's a whole new world of investing, there's a whole new world of doing it even better. And so I hope this created a lot of value for you guys tonight.
Yeah, and I've Chris, you're kind of a guy that I run some really random questions by from time to time. And I know a couple of simple passive cash flow listeners have gone to you for the counseling, and I know you like working with them because it's not like a blank slate. People know like what the heck they're doing when they go to you. And I know that makes your job a lot easier. So here's a question that comes up a lot, and we'll close the call with this. HELOCs, right? Like a lot of people have a lot of equity in their homes and they have HELOCs.
I don't know. Are you guys seeing Lane cut out?
Oh, yeah. So the question is, Chris, like, do you invest with your HELOC? Because personally, I've always been a little wary about, using that HELOC money to go after, using it for down payments and more properties. And this is like, you're not going to get this from a financial planner. I mean, a regular financial planner. So once you, I mean, it's all your opinion. What's your thoughts there?
Uh-huh. Yeah. HELOCs, I think like everything. I think of HELOC money just as sacred as my own money that I've worked hard for, right? And so I think everything's stewardship. I think everything you should be careful and be doing it smart. And this is why I like to go for cash flow investment deals. I'm not big on the big capital gains, like big home run type deals. I look for what's giving me steady cash flow. And especially if you got a HELOC, you really want to make sure you've got some of the steady cash flow that you're not going to lose your shirt in. You know, I think that's key.
Yeah, so if you guys have any questions on how I used my infinite, or I guess we'll call it the wealth, finally we'll call it the wealth formula banking method. And you guys want to know how much I put in and why I did that, shoot me an email at lane@simplepassivecashflow. And if you guys like this, do me a favor and share this with your friends. Just email the podcast, email the website, email this webinar to your friends. I stopped asking for Facebook shares because I realized a lot of you guys are just like me and like trying to live this alternate life. And like you guys have friended your work friends and your boss, and you guys are just totally scared about like the word getting out that you're trying to like build up passive cash flow so you can quit your job. So yeah, do me a favor and just share it with friends. That's the whole point of this, is to get people out of the stock market and into better investments.
Mm-hmm.
All right.
Absolutely.
All right. Thanks everybody. We'll see you guys later. Bye.
All right. We'll see you guys.